Next, we're going to move on the next stories, which is on the Trump. We can say that the Treasury yield curve could steepen as investors demand higher compensations for perceived fiscal and political risks amid rising pressure from the Trump administrations on the U.S. Federal Reserve. Bond fund managers said on Tuesday President Donald Trump's persistent criticism of the Fed board and Chair Jerome Powell for not lowering interest rates and his attempts to change the voting board's composition are chipping away at investors' confidence in the institution's authority. Yield curves steepen when long-term rates rise faster than short-term, reflecting concerns about a resurgence in inflation and bigger U.S. deficits. A popular trade this year, especially in the 5-year, 30-year yield curve, has been for investors to buy the shorter end and sell the 30-year bond. Skepticism over the Fed's independence is beginning to weigh on long-end yields, even as markets continue to conditionally trust the central bank, he said. Persistent U.S. deficits and heavy bond issuance have kept long-term treasuries pressured, even as short-end yields price in more aggressive Fed rate cuts. The 2-year yield, which typically moves in step with Fed rate expectation, fell to 3.51% on Tuesday after climbing to 3.578%, while the 10-year was at 4.03%, down in recent weeks as softer labor data spurred bets on policy easing. Stephen Parker, co-head of Global Investment Strategy at JP Morgan Private Bank, said investors were not being adequately compensated for inflation and fiscal worries, with the long end of the Treasury curve being most sensitive to those risks.